Hi, Greg Weldon here with episode number 10 of Money, Markets, and New Age Investing. And I came into my day yesterday when I was writing about the Federal Reserve and the minutes from their recent meeting here in June, just a few weeks ago. And it just reading these meeting minutes made me think of Animal House. And it made me think of the scene where Flounder, the freshman pledge, visiting the fraternity houses, real kind of goofy, innocent, naive guy, walks downstairs into this smoke-filled room with all these poker tables, and these guys, playing poker, and he interrupts the game and says, "Hey, gee, you guys playing cards?" And it's just one of those lines that you repeat and you repeat and you repeat. It's almost like, from Trading Places, where it ain't cool to be no jive turkeys so close to Thanksgiving. That's a great line. Certainly, Charlie Don't Surf from Apocalypse Now. I mean, these are lines that always get repeated. But I thought when I'm reading through the Fed minutes, just like, gee, you guys playing cards? And then you think about poker. The World Series of Poker is going on right now, which I've participated in. My recent history has actually really done quite well. So it's interesting to note that poker is a very complicated game, all right? Very complex. It's so situational. Everything has nuance. You're always looking for new information. And playing poker is similar to, trying to make a decision on interest rates right here. You have a lot of variables every time you meet, and you need to sort out those variables and come to the conclusion of what is the other guy holding. And if I bet, can I bluff him off the hand? Everything in poker comes down to a mathematical equation. That's why I enjoy the game. I don't gamble. I don't gamble at all. I don't do any other gambling, but I play poker because I can get the odds on my side. You can't get that in table games in Vegas. You're the one paying for the electric bill in Las Vegas, not the companies that own the hotels, let me tell you. So, but from that perspective, it then gets me to poker, which gets me to the Fed. And my view, if you've listened to some of these podcasts, I think that some of the recent hawkish talk, hawkish meaning more interest rate hikes, got to be tighter with policy, got to be more restrictive. The economy's too hot, and now we had inflation, and now the economy is not reacting to all the interest rate hikes, even though interest rate hikes take a long time to work through, and maybe it will be reacting at some point in time. We have to make sure we stamp out inflation here. So within that context, it's kind of like playing a big hand at a high-stakes poker table. The most recent minutes were very telling in the sense that publicly the Fed is saying more interest rate hikes. We got to be tighter. We got to be tougher. We have to defeat inflation, all while inflation is collapsing, as we knew it would. I've been telling you for months that it would, certainly since we started this podcast and before that for my regular clients, that inflation based on the base effect of energy prices, which rose $4.35 a gallon of gasoline last May and June. $4.35 last year. So, of course, now it's $3. It seems high, and it is high, but it's less than it was last year. So it puts huge downward pressure on inflation. We know the calendar. This is it. The next number, which comes tomorrow from when I'm recording this. It is Tuesday the 11th. CPI comes on Wednesday the 12th, which is tomorrow. It's expected to fall. It's 4% already, down from its highs, and it's expected to fall to 3.1 because gasoline is so much lower than it was a year ago. The good news and bad news of that is, or I should say the good news, the bad news, and the bad news of that. The good news is that inflation is now low compared to where it was and relative to Fed policy, because at 5.25% Fed policy rate, 3.1% inflation means you have a 2.4% real policy rate, positive. In other words, your policy rate's greater than the rate of inflation. We have had negative policy rates for years. Not only are rates zero, but relative to inflation, rates have been minus 200, minus 300, minus 400, depending where you are, right? Perpetually for a decade, which is one of the reasons now we're not so sure how this is going to progress the next time we have a recession. And yet the Fed is willing to bring that pain on. They've said that many times. But in that same vein, what we're talking about here is the bad news is that it's now a restrictive policy. It's no longer, it's gone from egregiously easy, like insanely easy, to neutral, to tight, to restrictive, where it is now, somewhat restrictive, with the chance of going to punitively restrictive, meaning it really clamps down on the economy. All right. Let's listen to a few things the Fed said in their meeting minutes. I'm going to read them to you. I wrote them down here by hand. Core PCE, the reading on core PCE, which means, no food and electricity, no food and energy. All right. So stripping out those two things makes it a smoother indicator. So Fed, the reading on core PCE provides a better signal about future inflation than the more volatile total measure. The most recent reading at 4.7 is the same as it was as recorded in January. So what is the Fed saying? The Fed's saying that inflation is still very high here at 4.7, and it's not changed over the year. All right? Now, the issue is that in January, Fed funds was 4%. So 4.7 then, you still had a negative real policy rate of minus 70 basis points. They lifted it to 4.5 in January, which then took it to a minus 20 basis points. It was still a negative real, in quotes, policy rate because it's the rate relative to inflation. And now finally was a lift in the Fed funds rate to 5.25. And now inflation falls, all right, at 4.7 on the PCE. Now the real rate is a positive 0.65. Finally, the rate is positive. Now, why does all this matter? It's a lot of gibberish, right? No, it's not. It's really important. Because in 2018, and I always reference this, because I did read every single page of 11 white papers published by the Federal Reserve, over 310 pages of theory and stuff like this about their new policy paradigms, the new policy protocols, where the Fed said we're going to let inflation get above average for a long period of time with no tolerance bands. In other words, we don't care how high it goes, and we're going to let it stay there. And they did exactly that. Of course, the pandemic and supply side, issues and supply chain disruptions and blockages caused that inflation to be really high. So the degree to which now the Fed feels, well, maybe it was too high, maybe we should have had a tolerance band, and maybe now we got to be really aggressive to bring it back in because we don't want a 1980 style, collapse in the economy. We want to try and get a soft landing. All right. One thing Paul Volcker said back in 1978 and 79 is we want to be tight, but we don't want to restrict credit. And that was key because Powell is not saying that. He's saying the opposite. And he is looking for a credit contraction. He really is. From what the Fed said here is, all right, here's more quotes from the Fed. Banks, in plural, banks' ability to fund loans to businesses and consumers remains somewhat strained. Banks continue to experience outflows of core deposits. Effects of tightening on bank credit conditions could prove more substantial than we anticipated. Delayed effects of tighter credit conditions potentially could contribute to a slowdown in economic activity. They have said they want credit to retrace. It needs to retrace. It's out of control, but it's the only way a lot of people are paying the bills. Credit card debt through the roof. I've said this how many times in this podcast. Consumers borrowing the most money ever at the highest cost to do so ever. It's not sustainable in any way, shape, or form. And that's why the most recent New York Fed household survey of consumers reflected that less people feel secure about the next 12 months that their financial situation will get better. More people, 34%, say financial conditions will get worse versus I think it was 21% saying financial conditions will be better for them. Over a third said, we expect our financial situation to be worse 12 months from now. All right. So part of the thought process is, well, we have credit. Let's buy stuff now. Maybe that's why the economy is kind of held in there. Okay. You also have the upper half of the income scale where, you do have some real wage growth and where people do feel, they can afford to pay higher prices. They've changed their buying habits, but not necessarily the amount of money they've spent. This too will change. So all of that, especially when credit tightens condition, and they will, and they're talking about, can banks even have the ability to keep making loans? Because you have $17 trillion in deposits, you got $15 trillion in loans. The Fed's balance sheet is going to be $40 trillion. I mean, the Treasury's public debt is going to be $40 trillion, and the Fed's balance sheet's $8 trillion. It's the lowest of them all. I mean, so just think about how much money you're going to have to print next time you have a recession when the labor market comes off. And that brings us to the labor market, because Friday, labor market report was really interesting. The tells that are usually precursors to a downturn in the labor market were flashing yellow flags around the racetrack, waving yellow flags around the racetrack. its caution lights on labor market now rolling over potentially. Even in the face of an ADP number last week that was really strong, even the head of ADP, a woman she's really, really good, Richardson is her name, I believe, was saying, the numbers were good here, but it seems like last gasp hiring into what is going to be much less availability of jobs, all right, to the point where it's also already weighing on wages. What does the labor market report show on Friday? Exactly the same thing, what she just said. All right, it comes down to that you have more people, 400 and I think 29, I forget the exact number. It's like 450-ish thousand people working, increase in the number of people working part-time for economic reasons or because there was slack work available. 400, and I believe it was 69. I'm just going to call it 69 because I think it was. 469,000, right, versus a private payroll gain of 149,000. Hello, McFly. Gee, you guys playing cards? I mean, when you look at not only that, all right, but when you look at the fact that out of the 19,000, the headline, BLS non-farm payroll number, 60,000 was the government. That's like 29%, 28 point something percent. So that's a big chunk of the jobs were government jobs, which tend to be lower paying, by the way. And the areas that were soft, leisure and hospitality and retail, two of the hottest employment growth sectors over the last year or so prior to this little downturn. All right. So this is a big tell for me. It really is. This little bit of a kind of a breakage in the employment numbers. There was a couple other little nuances like that too, in terms of educational attainment and in terms of certain types of jobs and in terms of even U6, which is the total unemployment rate, which rose for the second month in a row. U6 went from 6.6 2 months ago in April to 6.9. Even U1, which is the smallest measure, went from 1.1 to 1.2, and it has not risen in like months. I mean, for a long time. The tells on the forward indicators are waving caution flags at the labor market raceway. Just that simple. And, this race could get black flagged. We'll have to see. Back to the Fed real quick, because I want to get to one other comment the Fed made, which is mind-boggling to me. When it comes to foreign economies, core inflation has yet to materially decline. In this context, foreign central banks underscored, in conversations with the Fed, I guess, because listen to what he's saying, the foreign central banks underscored the need to raise policy rates further. Hello, Europe. 6.4 German inflation, still 3.75 policy rate. That's a negative number to a too large a degree. The ECB will have to raise rates again, which will put upward pressure on the euro, downward pressure on the dollar, and I'm going to get to all that in the market segment in just a minute. But that's key to note that this comment plays into that perfectly, all right? And here's the kicker from the Fed, that central banks underscored the need to raise policy rates further and be well positioned in case inflation fails to decline as expected. Chew on that for a second. Be well positioned in case inflation fails to decline as expected. Now, here's where it gets interesting, because the expected fall is over as of this month. So inflation might bottom at 3.1 if you get 3.1 print tomorrow on CPI. That might be the low. I said it would be a 3 handle. I said this on this podcast months ago. We've called this as well as anyone out there. All humility aside, it's on the podcast. In that vein, when it comes to foreign central banks, it's more important now to notice that those central banks that have been really aggressive are now carrying large, real, positive policy rates. They're tight in their policy. We haven't seen this in so long. This is what's really striking me here, right? The Fed, CPI falls to 3.1. You're talking about if a real Fed funds rate of over 2%. That's restrictive, like almost prohibitively, into a downturn in the labor market. That's the lagging indicator when we see credit's already suggesting the consumer's in trouble and the consumer's telling you they're in trouble. Gee, you guys playing cards? Let's talk about some of the central banks I just wrote about. Chile, positive. They were very aggressive. They took rates way up, and now they have a huge positive rate. And what's happening? The Chilean peso is one of the strongest currencies in the world. You have a positive real interest rate, you are going to dominate in foreign exchange. And that's a big part of what our play is here. And we're going to get to that because I'm going to give you my picks here today. All right? I sound like I'm a Vegas gambling guy. I'm going to give you my picks today for free for Sunday's games because we're 7 for 10. No, but seriously. Korea, here's a great case in point. Bank of Korea, highly respected central bank. Their policy rate a year ago was minus 6.30, minus 630 basis points. Deeply negative, very stimulative. They lifted rates so far so fast that inflation has collapsed to where the policy rate is now positive 1%. Thailand, the Bank of Thailand's a rock star central bank. They just are. They always have been. All right. Their inflation was their CPI last July, 12 months ago, was 8%. It's now 0.2. Whatever that is, 97% or more of that inflation is gone. Gone. 8% to 0.2. And it's been 0.5 or less in each of the last 2 months. I mean, it's gone. It's almost deflation in Thailand. Right? They went from, in July of last year, having a negative policy rate of minus 7.5%, minus 750 basis points. It's now plus 2%. From minus 7.5 to plus 2. The Philippines, all right? 8.7 inflation is now 5.4. Policy rates all the way up to 6.25. They have a positive real rate of almost 1%. But what's also happening in these places? Let's take the case of Taiwan, who just reported their most recent data. And my point here is their economies are under siege, and they have tight and restrictive policies now from a monetary perspective. Rate cuts in the U.S. may not come, but rate cuts overseas could come fast and furious, and in fact, they already are. I'm going to tell you about that in a second. I got a point here. Let's talk Taiwan. Taiwan, they had the largest year-over-year decline in exports. 70% of their economy derives their income from exports. The largest single-month decline in the year-over-year rate of change in exports since the 2008-2009 financial crisis. The only other time it was larger was in 2000 when the tech bubble burst. That's the level of economic data and how it compares to history. We've seen this in the U.S. too with some of the ISM reports and some of the Fed regional surveys, where the numbers have only been this bad in the pandemic, in the global crisis of 2008, and in the tech bubble crash. That's it. That's what you're comparing the data that we get now. Taiwan's exports from 39 billion to 32.3 billion. That's a 7 billion loss. 24% down year over year. Down with every trading partner double digits, down every product double digits. Japan has not hiked rates at all. They're still at minus 0.1 official policy rate, which when inflation went to 440, meant their real policy rate was minus 4.5, minus the 10 real rate, the nominal rate versus the 440 inflation, minus 4.5. Now it's minus 320. They've been bullish. They've been stimulative, I should say. Excuse me, not bullish on anything. Stimulative on the economy this entire time. And what's happened? The yen has been one of the weakest currencies on the face of the planet. Why? Because the rate dips, man. When you're at a minus 320, real policy rate right now, when you get a plus 2 in Thailand or plus 3.5 in Chile, you're talking about a 5% differential. That's big in moving money around just in terms of deposits and what you can earn in a week, in 2 weeks, in 3 months. All right? So let's get back to Japan, though. So they haven't raised rates at all. They haven't moved at all. And what the new governor just said at the last meeting, just literally 2 weeks ago, he said exactly this. He says, we're going to remain patiently stimulative with monetary policy. Patience is the word because they have been stimulative with monetary policy for like 20 years, right? That's some patience, man, all right? You can't show that kind of patience at the poker table and survive. You get what they call blinded out. But that's just amazing. So what's going on in Japan right now? You have back-to-back declines in household spending of 4% or more year over year, down 6 of the last 7 months. We saw the same thing in France. Big decline in inflation. What happened? Household spending dropped off the face of the planet. This is kind of the risk here. So what happens here with the markets? Let's talk about the markets. Oh, wait, I want to go back because interesting to note, what was I was going to say before when I started talking about Taiwan? Oh, yes, rate cuts could come fast and furious. The Vietnamese central bank has already cut their rate 3 times by 50 basis points each time and still has a positive real interest rate, meaning they are still not stimulative. This is going to be the case when you see inflation come down, when you see the economies do what they're doing, and you get to this point where the Fed finally, kind of throws in the towel. Man, things are going to change quickly, and it's going to be fast and furious. I mean, maybe that's the title of this today. I was going to make it, gee, you guys playing cards, but really it's fast and furious rate cuts in other places in the world where the economies are hurting already. And you have policy rates now that are prohibitive and restrictive. I wouldn't say prohibitive, but they're restrictive. And, so at any rate, and inflation could come back, and it probably will, and that's going to screw everybody up because you have El Nino on food prices and energy prices. Energy breaks out. It looks like crude's going to break out here. You end the base effect, which means every monthly change now becomes the differential for the year-over-year equation. And when you get to this point next year, you'll have very low prices to compare, and inflation could be through the roof again. This is the Fed's problem. They're afraid of that. They are petrified of exactly that happening, and it's probably going to happen. And there's probably nothing they can do about it, and they're going to stoke it, because they're going to be forced to. And let's look at the markets, because what are the markets telling us? The market action in the last 24 hours is telling me something is changing right here, right now. I've been doing this so long, and when I was looking at some of the things I saw this morning, I'm like, this is where I got to do a podcast. Because it could be a significant day when you look back. Let's look at what the markets have done over the last year, really 18 to 24 months. Because these have been some of the most difficult markets to trade that I've seen in my entire 40 years of doing this. I've seen other occasions when certain market sectors were like this, but never where everything was like this at the same time. But every other time that this has been the case with foreign exchange or the bond market, the commodities not going anywhere, gold's not going anywhere, or whatever. I've seen this particularly in foreign exchange in the 94, 95, 96. Foreign exchange was kind of a one-way street. Some of the currencies were going up very gradually, but not much was happening. You had the Asian countries were expanding trade, and their export numbers were great, and they were supporting their currencies, and so on and so forth. And everyone was kind of happy, right? And no one was making money that was trading foreign exchange because these things weren't moving at all, right? But it always is a precursor to giant moves. You can only hold the beach ball under the water level in the pool for so long before when you let it go, it explodes up through the pool. It gets everyone wet. I think everyone's about to get wet. And hopefully that means, wet with money in terms of keeping pace with the inflation that's coming down the pike. Because this is where, it's like, well, are we taking advantage of things? And, is this right? And it's like, yeah, you need to protect yourself and your wealth. This is the point. This is the game. This is the goal. This is it right now. It really is when you talk about finance. Let's look real quickly. Gasoline prices, because I got a little bit more in the markets. I want to give you some decent picks here going out, and I want to keep this under half an hour. Gasoline prices, okay? I'm using the spot futures contract, so the spot market, the nearest delivery. Okay, August of 2022, last summer, gasoline was $2.46. Okay, the 2-year moving average was $2.55. Today, gasoline's $2.55, and the 2-year moving average is $2.55. It hasn't moved at all, even though you've been up big and you've been down big. Gasoline has not moved barely a penny in 12 months. Gold. July of 2020, gold was $1,943 an ounce. 3 years later, July of 2023, right now, today, gold is $1,943. The exact same price from 3 years ago. In the meantime, you went to 2080, then you went all the way to 1610, then you went back to 2080, and now you've come down to 1700, and now you're back to 1900. You have ranged this thing like, first of all, the peak to trough range is $500, $470. The overall range up and down is closer to $600, $700 on an item that costs $1,900 and has gone nowhere for 3 years. this is why you got to be careful when you're trading these markets, because those swings will eat you alive and ends up going nowhere. Soybeans, January of 2022, so 18 months ago, $15.15 a bushel. Where is it now? $15.15 a bushel. No change? Are you kidding me? It went to $18, down to $12.50. Then it had a $5 swing up and down. Then it had a $2.50 swing up and down, for basically a total of $10 move on a $15 commodity, and it went nowhere. That $10 used to be a $5 range, and it went nowhere. That $5 on one futures contract is $25,000. It was $5.15 actually was the range. I calculated to the penny. $25,300 on one futures contract. How are you supposed to be trading futures for 50 grand when the swings in soybeans over the last 18 months, with the price not making any change, could have cost you $25,300? Now the dollar, because the dollar got hit today, and that's what really caught my attention, in line with the payroll numbers on the part-time employment and some of the other things. Yeah. Beginning of 2023, the beginning of this year, 103. Where is it now? 102.60. It's pretty much the same place. It's not even 0.5% move, all right? In the meantime, the range from peak to trough, and we've done it twice, is 5%. So you have a 10% move, and you've moved less than 1%. But I think these things are changing, because I think the dynamic around the Fed is going to change. I think it is finally now changing. You're coming into the zone where I believe now this employment number, if they hike one more time, that's it. And it doesn't matter, because the market's already seeing through this, all right? The current 2-year Treasury note, all right, is trading at 5. It just double topped here at 5.10, 5.1%, all right? From that same perspective, the 2-year forward Fed funds rate is 3.90. It's below 4. So, I think the market is already seeing through this. In this case, all right, 2-year note, fixed income could be a buy here on a short-term basis. All right. But what's interesting about it is, because of this, Europe is going to continue to hike rates. They have to. All right. What's happening here is the 2-year note versus the German 2-year Schatzi is what it's called instead of Treasury. All right. And the 30-year German U.S. bond versus the 30-year German Bund. Those rate differentials are what they call rate diffs. You have a yield premium of about 1.4% right now in the 30-year U.S. That's shrinking. As that shrinks, it puts downward pressure on the dollar. The move in the rate spreads are very closely, tightly, positively correlated to moves in the dollar. All right. We have picked out now, of course, Swiss franc, British pound, Mexican peso, and now adding kind of Brazilian real. All right. So XYF, FXP, FXF are the two ETFs for the Swiss franc and British pound. Mexican peso doesn't have an ETF. The Brazilian real doesn't have an ETF. But that's where we get the CEW, which is the emerging market ETF. So the ETF for the Swiss franc, the ETF for the British pound, the ETF for the emerging markets, the CEW is the latter. Now, what really caught my interest in the context of all of this was something I didn't expect to see, and something that really caught me off guard and really floored me. All right. First of all, gold has held the 200-day moving average. All right. And you have, overhead resistance, which is probably going to break out if the dollar breaks down. Dollar's level is par 80 on the dollar index, the cash dollar index, the USDX. If the dollar gets below par 80, is 100.80, it's a breakdown, and that's going to change everything. Commodities are going to take off. Gold and silver are going to take off. But it's like gold and silver have been non-starters. They've been frustrating. They really have. And then I saw this morning. The junior gold miners, the speculative, low-priced, don't even pull gold out of the ground. They go up in value because gold goes up in value, and there's some point where it pays some other company to take them over to get the gold out of the ground, or just the gold in the ground gets even more valuable where the share price goes up. All right, real speculative stocks. I don't want to call them penny stocks because that wouldn't be fair. But, it's the speculative side of the mining share arena. Now, the junior gold miners usually lead in the biggest bull periods. That's the leader, because you got the speculative money coming in. And that's the fervor, and that's what drives the market to its highs. You want that until you don't want that, okay? Until it gets too frothy. But it doesn't happen at the turn, where the GDX is outperforming the GDXJ for juniors. Okay. GDX is the gold mining ETF. GDXJ is the junior gold mining ETF. GDXJ is outperforming the headline index. GDXJ is outperforming the price of gold. GDXJ right now, the speculative junior gold mining shares over the last 52 weeks are outperforming the S&P 500. The GDX gets above 3860. It's currently at 3626. It's probably going to be worth owning. Keep an eye on the GDX. I will be working on a special on the gold mining shares at some point in the future here if this market starts to get hot. So I don't know if anyone out there might want to see a copy of that when I get it done. You can always shoot me an email. But from this perspective, I really believe that things are about to shake loose, and this 12 to 18 to 24 month logjam of markets going nowhere but going all over the place. False, bull traps, bear traps, false breakouts, false breakdowns. Oh my God, it's been kind of crazy. All of this, I believe, is on the verge of changing, and certainly within the next few weeks, we could see the effect of that. Don't forget too, El Nino continues to wreak havoc out there. So that's another thing to keep an eye on in the news. Greg Weldon, episode 10 in the books. Thank you for listening.